It is possible to get a bigger tax refund using your retirement plans and still get money into the Roth IRA. And I'm gonna show you exactly how to do it. What's going on, guys? Welcome back to the channel. Or if this is your first time at our channel, welcome to the channel. My name is Travis Sickle, and let's get right into this. So the Roth IRA goes in after tax. You make those contributions that are already taxable. So it's money that you're getting from your paycheck, that money's already been taxed, and you can make that contribution directly into the Roth IRA. Now that does not reduce your taxable situation in the year of your contribution. But if you look at the traditional IRA, when you make that contribution, it is deductible as long as you're making a deductible contribution. So there are two types of contributions that you can make into the traditional IRA, a deductible and a non-deductible contribution. Now, when you're putting money into the traditional IRA and you want to get it over to the Roth side, usually what you're hearing is a backdoor Roth conversion, and that is non-deductible money going into the traditional IRA and then taking that money and putting it over to the Roth. The reason that you would do that is because you're earning too much money and you can't make a direct contribution into the Roth IRA, but you could still make a non-deductible contribution into the traditional IRA. But there's another way to look at all of this. So I'm going to draw it out so you can see exactly how this is done. So if we take a look at the traditional IRA and the Roth IRA, like I said before, the Roth IRA goes in after tax, so it's already taxable, but there are two ways that we can get money into the traditional IRA, a deductible and a non-deductible contribution. So if we contribute up to $6,000 into our traditional IRA, or an additional $1,000, bringing it to $7,000 if you're 50 or older, then you can make that contribution into the traditional IRA and then convert it over to the Roth side. But here's what you really need to know to make this strategy work. The contribution into the traditional IRA, if you can make it as a deductible contribution, you're going to lower your taxable income for the year that you're making that contribution. Now, you can make the contribution into your IRAs retroactively up until your tax filing deadline. So if you make that contribution, even if you make it in 2022, as long as it's coded for 2021 and you're doing it before you file your taxes before the April deadline, then it is deductible for 2021. So then we can convert it from the traditional IRA over to the Roth IRA. Yes, that is going to be taxable at that point, but it is taxable in the year of the conversion, because what you cannot do is you cannot do a conversion retroactively, but you can do the contribution retroactively. So if we take a look back at our illustration and we make the contribution of $6,000 for 2021, it's going to lower your taxable income. If you're getting a refund, it's going to be a bigger refund, and then you're going to do the conversion, and that conversion is taxable. So it's taxable for the year that you're doing the conversion. So that's going to be for 2022. Now, you don't have to do it that way. You can make a non-deductible contribution and not take the deduction for 2021. But if you want a bigger tax refund, then make it as a deductible contribution and then convert it. And that is how you can reduce your taxable income for 2021 and still get the money into the Roth IRA. Now, this isn't gonna work for everybody. You have to be eligible in order to make the contribution into the traditional IRA to use this strategy as a deductible contribution. But this is one thing that you can look at to figure out how to reduce your taxes and get a bigger tax refund. If you have any questions on this, let me know in the comments down below. And if you've enjoyed this video, be sure to subscribe, and we'll see you on the next one.